Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenters will answer those queries during or after the webinar today as appropriate. And if you ask a question in the chat box and we're not able to get to you, go ahead and leave your phone number as well. We will make sure someone reaches out to you to address that concern you have. Once again, we want this experience to be as educational as possible. Please don't hesitate to ask for clarification or expansion of the material. That is what we're here for. Well, I'd love to introduce you to today's guests. Our moderator today will be Chase Tusshouse, and he's a partner with Tusshouse Group and Tusshouse Wealth Management. Prior to becoming a financial advisor, Chase worked in the manufacturing industry as an engineer for L3 Harris and SpaceX. Chase graduated from the University of San Diego with a Bachelor of Arts and Science degrees in Industrial and Systems Engineering. He is a member of the University of San Diego Alumni Board, the co-chair of USD's Shiley Marcos School of Engineering and Computer Science Alumni Council, and a member of the Oceanside Theater Company Board of Directors. He and his wife, Julia, are parishioners at St. Charles Borromeo, I'm sorry for mispronouncing that, in Point Loma, and spend their time mentoring local youth. Our presenter, actually, before I introduce our presenter, Chase, why don't you go ahead and say a few words so people can see you?
Thank you, Marche. Yeah, very excited to join everyone here today. Josh Stamer with Foundation Source. He and I have worked together in the past, and I think he's going to bring a lot of expertise today to charitable giving overall, and then how private family foundations might fit in there. So very excited, and I will turn it over to you to introduce Josh.
Okay, great. Well, we're very pleased to have Josh Stamer here from Foundation Source. He serves as the Senior Managing Director for the West Region, working with wealth managers, financial advisors, attorneys, and donors who either have or are interested in establishing a private foundation. He has extensive experience in both financial and client services. And prior to Foundation Source, Josh was the Western Regional Sales Director with Workiva, formerly Web Filings, where he successfully onboarded and developed client partnerships with some of the nation's largest banks, insurance companies, and mutual and hedge fund organizations. Josh graduated magna cum laude from California State University, Long Beach, and from the University of Wollongong in New South Wales, Australia, where he focused on business management. And Josh, we're so pleased to have you here. I'm going to go ahead and turn the time over to you now.
Terrific. Thank you so much, Marche. I appreciate it. And Chase, thank you as always. Really appreciative to both Advice Chaser and Tusshouse Group for the opportunity to join you both today. So I can see we have on the screen the introduction slide already, Marche, so thanks for getting that set up. Today's topic would be an introduction to charitable planning, or charitable planning 101, as we kind of effectively refer to the topic today. And I'm so excited to lead this discussion for Advice Chaser, because as we're all aware, philanthropy and charitable giving is an incredibly important topic for everyone, both in the financial services space, but also all Americans in general. So a little bit about Foundation Source, the organization that I work with. We were founded back in the year 2000, and for the last 21 years, we've really been focused specifically and entirely on the private non-operating foundation space. We're obviously very well versed in all charitable vehicle types. However, we focus our means of business entirely on the private non-operating space. For the conversation today, we'll be talking about several different charitable giving and philanthropic vehicles, including donor-advised funds, charitable trusts, and of course, private foundations. But thought it would be a great opportunity to talk a little bit about the philanthropic landscape in leading up to talking through some of our topics today. So Foundation Source is based in Fairfield, Connecticut. We have about 2,000 clients, foundations that we are privileged to work with. And for the last 21 years, as mentioned, we've really focused on helping our philanthropic partners become more successful. So thank you for popping over to the agenda slide. We're going to look at a couple of different areas today. First, we're going to start with kind of, as I mentioned, the charitable giving landscape, the idea that Americans are very inherently generous and are highly participatory in the philanthropic and charitable giving space. Then we'll look a little bit about the idea of charting a philanthropic course and how some of our individuals, families, and corporations go about the idea of starting with a roadmap and then furthering that into their philanthropic goals. Next, we'll talk about some of the common charitable vehicles as referenced a moment ago. And then finally, we'll talk a little bit about how Foundation Source works with our clients. We'll give a little bit of example and case study information that I'm sure will be relatable for everyone in the audience today. Okay, so let's jump right in. As we see on the slide here, Americans are very generous, right? I think a lot of people are very surprised to hear that, and again, I'll reference this as 2019 total year data. The 2020 and 2021 data have not been finalized yet. So while these numbers are very accurate, they are going to be actually a little bit low compared with what we're going to see in 2020 and 2021. So Americans gave roughly $450 billion to charity in 2019. You can see how those giving dollars have gone over the last 20 years or so, 40 years or so, based on the slide, and kind of takes us up to today, where we're seeing close to $500 billion given away annually through charitable giving means. So where are the majority of those donations made up in? As you can see on the screen, corporations, bequests, foundations, and individual giving make up the entire pool of that giving. The overwhelming amount is direct giving through individuals, followed by private foundations, bequests, and corporate giving. So changes by source, this is a pretty fluid slide that shows that there are many factors that affect how charitable giving is viewed and completed here in the US. Over the last several years, we've seen increases in certain demographics, decreases in others. However, what we continue to see is that corporations are giving more and more every year. Individuals continue to give more and more every year. Foundations and bequests tend to go up and down quite a bit, but the total giving year over year has increased significantly, more so even in these last 2 years than the prior 5 to 6 years combined. So we're coming at this from a place of incredible growth in the marketplace. Lots of things are referenced in that growth. The marketplace, the focus on family giving, the focus on legacy and financial planning, these are all attributing to major growth in the charitable giving space.
Hey, Josh, real quick question just kind of came in here. Maybe you could define real quick, what are we talking about when we talk about bequests, corporation giving, just maybe highlight each of those real quick, but just to better clarify for our viewers.
Yeah, great question, Chase. So when we think about individual giving, we're typically thinking about our gifts that we make to our kids' school and to our church and to our favorite charity. And when we go to charitable events, the support that we're giving to those organizations, really more so as checkbook philanthropy, if you think about that way, right? You identify with a cause, you want to support that cause, so you break open the checkbook or you make a donation via your credit card, really as an individual. When we think about foundations, it's just that. So people who have a private foundation, who have established a charitable giving vehicle in the name of either their family or as a member of a corporate foundation even, the idea that they're making a grant out of that charitable vehicle that's been established as its own separate entity. So that's where we look at our foundation giving. Bequests are typically thought of as a couple of things, right? So gifts in perpetuity that have made via an estate plan. A bequest can be a multi-year gift that's established in someone's name over time. So when we think about kind of the bequests category, we're thinking about more structured giving over time that can be due to a family member passing away and leaving something in a trust or a will or otherwise, but that's kind of where we have the bequest category. And then on the corporation side, as mentioned before, corporate philanthropy is on a significant rise here in the US. So more and more corporations have gone the route of establishing either a corporate foundation or a more widespread corporate giving plan that can spread across multiple vehicles. We see things like employee match becoming more prevalent with organizations now more than ever before. So when we think about the rise of corporate philanthropy, we're talking about the gifting that's done directly from corporations to partner charitable organizations that they support. So hopefully that gives a little bit of detail on those sections that we're seeing there, Chase.
Yeah, that was great. Thanks, Josh.
Absolutely, absolutely. And Chase, you know me, I love to keep these things conversational. So anytime you want to jump in and talk through some of this data, just let me know, okay?
Awesome, you got it. Thank you.
So when we think about where all this money is going, right? Where is the vast majority of the recipient organizations that are receiving this type of support from individuals, families, corporations, foundations, bequests? These are kind of the top areas that are recognized by the IRS based on category codes as to where the majority of the charitable gifts are made. So up at the top, you see religious causes, followed by education, human services, gifts to grant-making foundations, right? So that's people supporting foundations that are then making gifts on their behalf. Not a lot of surprises on this list when we talk through with the vast majority of people. This all tends to be kind of in the wheelhouse of the majority of what people think when they think about charitable contributions. But I do find it interesting that, again, this does tend to fluctuate year over year. Now, in the last 2 years, we've had some major events going on. We've had a pandemic, we've had natural disasters, we've had fires and earthquakes, and some of what we see is in direct support of immediate things that are happening in the world. Others are more static, right? Like at the top, we see religious causes, education, human services. So while we do see spikes in certain areas at certain times, certain years, this does tend to be pretty static over the last 30, 40 years or so. Okay, so now that we've kind of discussed the landscape a little bit of charitable giving and figured out kind of where the dollars are going and how much the dollars are available for the gifting, talk a little bit about ways that philanthropists, clients of Foundation Source, clients of yours, Chase, think about charting a philanthropic course. They've decided they're going to make a commitment to be charitable, right? But what's next? So when donors have that maybe internal or family related dialogue, these are some of the things that we see them exploring. So starting up at the top, identifying motivations is very important for our clients, right? What's motivating someone to give? Sometimes it's a pull at the heartstrings. Sometimes it's a family member who's been affected by something specific. Other times it's just the idea that you'd like to make the world a little bit of a better place. So identifying motivations is really important in the overall conversation about charitable giving. Deciding what you care about is a challenge, right? There's so many things that our clients care about. Understanding if you're going to take a more widespread approach to philanthropy and chip away at many of the areas that we referenced on that last slide, or if you're going to be more dedicated in one specific area to try to generate more impact about one or two or three ideas that you really care about. And then finally, exploring the charitable giving options. So and this is different for everyone. For some people, this is continuing with charitable, with checkbook philanthropy. For some people, this is setting up a donor advised fund or a private foundation and setting up more of a structured charitable vehicle. Some of this is family philanthropy. Some of it's individual, some of it's corporate philanthropy. So when we think about what we want to achieve as donors or philanthropists, these are some of the considerations that are often walked through. I like the line over here on the right where it says, where it says donors make the most sustained and successful contributions when they focus on issues that connect directly to their motivations and convictions. And this really tells us a lot about kind of what our clients and what our donors and what our philanthropists here in the US care about, because we're talking about a cross-section of both generating impact as well as fulfillment, and the idea that you're going to give more if you're more closely connected with the causes that you care most about. So identifying motivations, well, there's lots, right? We kind of have this fairly cheesy expression in the private foundation space where we say, if you've seen one private foundation, you've seen one private foundation. And that's really the case for all donors, right? Because nobody is really truly aligned in one way more so than anyone else. So these are just some of the most contributing factors to identifying donor motivation that we see. So some people give because it makes them feel good. Some people give because it's in line with their profession. Some people give because it's a motivation around the idea of karma, and they feel like that it's good things are going to happen to them if they give. Some people give because it's a family tradition that's been instilled in them for generations. Some people are new philanthropists. Some people like the idea that they can take a tax deduction on their charitable gift, and that their dollar might be able to go a little bit further in that capacity. So while there are many different motivators that we see with philanthropists, these are just some of maybe the more major ones on the screen here. So deciding what you care about as a philanthropist, again, very diverse list here, but when we think about the areas of change that our philanthropists are most likely to target when they see their support, these are kind of some of the areas that we see, right? Big challenges, major issues, things like poverty, disease, education, climate change. For some people, those are areas that they consider the top of their list in a philanthropic approach, because they think that these are the things that we need to solve to be able to have a more secure future. Some people narrow that list and they like to focus on things like giving people jobs and curing a specific disease state, or water conservation that maybe sit below something as major as climate change and are focusing on water conservation. So some people take a little bit of a more narrow approach to the funnel. Some people focus on different demographics entirely. Some people want to focus on women or children or the homeless or animals. Some people focus on specific regions because maybe their family came from Asia or Africa, and they feel ties to that region of the world that they'd like to make the impact and feel the fulfillment on. And then finally, some people explore giving directly to other organizations. These can be churches and museums and universities where they've had success and they attribute some of their goals to be coming from. So when we think about our clients who go through the process of deciding what they care about, these are some of the big items that they walk through. Perfect. And then, so finally, exploring charitable giving options. And I mentioned before, for the vast majority of donors in the United States, checkbooks are what they're using to make their donations. However, we do see more and more every year individuals who have had some sort of success or have the financial means to do so, or the family goals to do so, move toward what we refer to as a charitable giving vehicle, which means that they've gotten to a place where they'd really like to formalize their giving in one way or another. The four most common established charitable vehicles that we see are what you're seeing on your screen here. So charitable remainder trusts, charitable lead trusts, donor advised funds, and private foundations. Again, still considering that public charities are predominantly supported by checkbook philanthropy. So we're not going to talk about public charities, but we're going to talk about more of the distribution type vehicles that you see on your screen here. So I think we're going to dig into these individually here for a moment. You can go ahead and advance it. Perfect. So let's talk about the first one that we mentioned, which is a charitable remainder trust. And as Marche mentioned earlier, always a terrific idea to have a conversation with your financial services professional, whether that's your tax advisor, your financial advisor, your wealth strategist, your planning associate, whoever that person is, because as we discuss these different types of gifts, as mentioned before, some are going to be a great fit for some people and some are going to be a better fit for others. So as we move through these, we're really going to talk about some of the advantages and some of the considerations with each of these. So the first one is a charitable remainder trust, or commonly referred to as a CRT. And Chase, I know you have some experience in this area as well, but generally what a charitable remainder trust allows for is the means for someone to make ongoing contributions or one initial large contribution into a vehicle like a charitable remainder trust. It allows you to take a cash flow on an ongoing basis out of that trust, meaning that if you potentially need an income or you need some sort of cash flow or an income stream, you're able to do so. And then the idea of whatever's left over, either at the time of the expiration of that trust or at the time of your death, the remainder moves directly to either your favorite public charity or to your own private foundation, and so forth. So some of the considerations there you see on your right, generally these CRTs are set up with the assistance of a planning attorney. Gifts to a CRT do not typically qualify for the annual gift exclusion, and then distributions to the beneficiary during the life of the trust are included in the recipient's gross income for tax purposes. So while you are drawing an income, it is kind of taxed as an income, but a lot of people love the idea of utilizing a CRT because it shows them an end game related to their philanthropy. They feel good about knowing that while they have the flexibility of taking an income stream, the majority of what the causes that they care about are going to be cared for at the expiration of that trust or after their death. So that's typically what we see in a CRT. Chase, unless you wanted to add any comments, we can move on to the next one.
Yeah, Josh, I was just going to ask, got a question about just so you're talking about the income, and then after the end or the expiration of the trust, right? Then there's also distribution, right? And so can you clarify just which one of those is toward the charity? Is it both? Is it one? Is it the other? And which is the benefit of potentially the trust owner?
Yeah, so in the case of a remainder trust, the remainder would then be moved on excuse me, to either the donor's list or individual charity that they're working with, or a small list of charities that they've pre-designated as the recipient, which also can be, the individual donors or family's private foundation. So that would be kind of the benefit of setting up a CRT, is knowing that the remainder in this case would be moved on to their charitable causes.
Yeah, I didn't want to jump ahead here, but I was going to wait till we had kind of covered all these charitable vehicles, but
perfect.
Some questions around using more than one. So we'll hold that till the end.
No problem. No problem. Happy to talk through it.
Yeah.
Oh, perfect. I'm sorry. I didn't see we advanced the slides there, Marcia. You're too quick on the trigger for me. So the next one that we're going to talk through is the charitable lead trust. So kind of the opposite side of the charitable remainder trust, right? So the advantage here is that you're provided a tax-free gift to the donor's family upon termination, meaning that just the opposite of a charitable remainder trust, a charitable lead trust would make ongoing gifts to the charitable organizations that the family or the donor identifies. And then at the expiration of the trust, what's left over would move directly to the donor's family. So just like the CRT, only in reverse. Again, same considerations of setting up a CRT. Certainly want to talk through this with your attorney, your financial planning professional, because it's different for everyone. Some people are going to see an advantage in a CLT versus a CRT and vice versa. I'm in no way an expert on charitable remainder, charitable lead trusts. However, they are very commonly employed strategies for our financial, or for our donors. So next up, we have the DonorAdvise Fund, again, commonly referred to as the DAF, right? So the DonorAdvise Fund space is one of the fastest growing demographics in all of the financial services space. So donor-advised funds, while they've been around for a very long time, they've really kind of come more into foray here in the last probably 10 to 15 years. So donor-advised funds can be set up typically with a minimum contribution of anywhere from $5,000 to $25,000, really dependent on the individual donor-advised fund sponsor. And they provide donors with a current year income tax deduction of up to 60% of their adjusted gross income for cash, or up to 30% for marketable securities as a donation. Donor advised funds are very easy to set up. They can be set up in a myriad of ways. They can be set up with a donor advised fund at a national level, maybe sponsored by a financial services organization. They can be set up at a more localized level in partnership with a community foundation. So you really have multiple ways of setting up an individual donor advised fund. Why are donor advised funds terrific for the American philanthropist? Well, it encourages more families, individuals, and corporations to be able to set up a structured philanthropic vehicle, typically at a much lower entry space or entry rate than other charitable giving vehicles. The easiest way, in my opinion, Chase, to think about a donor advised fund is to think about it as kind of a designated charitable checking account, right? The idea that as a donor, you can make a gift, a large gift, into a donor advised fund. And then you're taking a deduction from a tax perspective on that total gift upon contribution into the donor advised fund. But then you can advise on how you'd like those disbursements and distributions to be made over time, already having taken the deduction on the total amount in the year of establishment. So they tend to be a very flexible vehicle. They tend to be very straightforward and easy to work through. They can be a little bit limiting as far as what you can do as a philanthropist. As mentioned before, typically the donor advised fund is set up to specifically make distributions or give grants directly to US-based 501c3 organizations. So how they work is the donor advised fund funds the DAF. They make recommendations, or quote unquote advise, on how they'd like their distributions and grants made out of that organization. So some considerations, some people think that donor advised funds can be more challenging because they tend to not have as much flexibility and control of other philanthropic vehicles. Again, there are some restrictions around grants, typically limited to US-based public charities. There can be some limitations around the types of assets that are able to be contributed to donor advised funds. And there are some limitations around what you can do as a more active philanthropist. The idea that you're not really incurring expenses and doing some of the other things that are available, maybe with a private foundation. So I'll stop there. Chase, I know that we're probably gonna jump through some comparisons here when we talk about the vehicles as a whole. So unless you wanted to add anything, we can jump on to the next one, which is private foundations.
Now, the only thing I was going to mention, which you just hit, was the fact that you are giving over that legal control of the funds, and that it's the sponsoring organization that has essentially the final approval, right? You know, of where did those funds go, and I think that's important to consider. I'm sure you would
Absolutely,
agree.
absolutely. It's a great point, Chase. And as I mentioned, donor advised funds are terrific because they're very straightforward. They're easy to use. They're easy to deploy. They give a terrific tax deduction. But as mentioned, it can be limiting for people who are looking for and retaining the utmost control and flexibility, right? I bring up flexibility because one of maybe the downsides of a donor advised fund is they are irrevocable, right? They're a non-transitive vehicle. When you fund a donor advised fund as a donor, those funds now belong to that donor advised fund. Not in a sense that you would want to pull those funds back, because with any charitable vehicle, you're really making an irrevocable gift. But other charitable vehicles allow for distributions out of that particular vehicle, and some do not. So an example being that if you fund a donor advised fund, you can't make distributions out of your donor advised fund to a private foundation. Whereas in a private foundation, if you decide that you'd like to make distributions out of your private foundation to a donor advised fund, you're completely allowed to do so. Donor advised funds at their core are in essence an account held underneath a public charity, right? So you have a sponsoring organization, which is the public charity, which has its own 501c3. And then a donor advised fund is an individual donor level account held underneath that 501c3. So thus the designation around making gifts and distributions directly to other US-based 501c3s, not to private foundations. Typically not directly to international organizations or individuals as scholarships and so on and so forth.
Yeah, that makes a lot of sense, Josh. Thanks for kind of breaking that down. I think another question here is, okay, so the sponsoring organization kind of gets the final say on where your money that you just gifted to them, where does that get used, right? Do they also have the final say on potentially how the money is invested? Does it depend on the organization, I suppose?
Yeah, it's a great question. It's a great question, Chase. And you kind of hit it spot on, right? Every donor advised fund sponsoring organization is typically going to have their own kind of breakpoints at where they allow different levels of flexibility when it comes to the assets that are contributed, right? Some donor advised fund sponsors have a threshold of 250,000 up to 250,000. You are limited to a very straightforward, more boilerplate approach to the investments that you're able to access. And then anything above 250,000 in assets, you have a wider range of the type of investments that you have access to. I wouldn't want to speak to the individual requirements just because there's so many. Like I mentioned before, there are literally dozens of donor advised fund providers, and they all tend to have a little bit different rules when it comes to the investment platforms that you have access to.
Yeah, and I would also note that that includes not just stocks and bonds, right? Like those liquid assets, but other unique assets, real estate, other property like that. So
absolutely, yep, great point. It's not just your standard investments. It's going to get into some of the things that you may or may not have access from an investment standpoint within a donor advised fund.
Thanks, Josh. You
got it. All right, so let's talk about the last one of private foundations. Again, this is kind of my world. This is the space where I spend the predominant amount of my time working through. I'll stay as judicious as possible as we can here, but certainly, as mentioned, working in the private foundation space now for the last 8 years, this is kind of the area where I have more of a level of expertise. So private foundations, as defined, is an independent legal entity established for charitable purposes, typically governed by an individual, family, or a company. So when we think of private foundations, a lot of people's mind automatically goes to the Ford Foundation or the Bill and Melinda Gates Foundation, or some of the very large, well-established entities that we think of from a philanthropy perspective. But truth be told, of the roughly 80 to 90,000 private foundations that are established here in the United States, the vast majority of them tend to be closer to that $1 to $5 million range when it comes to size. So over the last, call it 20 years, we've seen the demographic for private foundations decrease incredibly, making it more accessible for more people to have or enter into the private foundation space. So talk a little bit about some of the advantages of a private foundation. Well, as you referenced before, Chase, the donor maintains complete control over everything related to the private foundation, right? They're going to set up an independent board that could be made up of them or family members or colleagues or business associates that are going to direct everything within that private foundation. You're talking about, opposed to a donor-advised fund, you're talking about a separate legal entity that does not owe responsibility or need to check with anyone prior to taking on its activity, okay? Again, can be funded with and continue to hold really any type of asset. So we're talking about private equity, tangible assets, artwork, car collections, real estate, tangible property, in addition to your straightforward cash and marketable security type assets. So when you think about asset classes, you're certainly going to have the widest range within a private foundation of all charitable giving vehicles. And then finally, some advantages being on the types of activities that a private foundation, that a donor can employ out of a private foundation. So not just limited to making grants to other 501c3 organizations. Private foundations can gift to other private foundations. They can gift directly to individuals for hardship emergency type grants. They can give through scholarship programs. They can make program related investments, which might be making loans or taking a equity interest in a for-profit organization. They can make direct international gifts. They can run their own programs. So what we see is a lot of the advantages of a private foundation tend to point to a couple different areas, right? They tend to point to individuals, families, and corporations that may want to take a more quote unquote active approach in their charitable giving. They may want to travel to visit different countries or different organizations that they're supporting. They may want to have their family members or children more engaged as junior board members to learn about what philanthropy is. So there's a wide array of advantages that a private foundation can bring to an individual, a family, or a corporation. One of the biggest differences that a private foundation can employ as a structure is the idea of incurring expenses or charitable expenses on behalf of the foundation. So as mentioned before, Chase, a lot of people aren't satisfied in just making grants or writing checks to some of the organizations that they'd like to support. Instead, they'd like to be more personally engaged with that organization. I have clients who run clean water initiatives in Africa, and they fly to Africa and they get to work with that organization. I have others who participate in group type of activities on the East Coast. I'm based here on the West Coast, and they fly and travel to the East Coast to participate directly with some of the organizations that they're working with. One of the nice things about a private foundation, as mentioned before, is you can incur charitable expenses. So not all of your activity needs to be dedicated through the means of writing grants or gifting checks to other organizations. So a couple of considerations here on the right. Private foundations do have what's called the minimum distribution requirement. You'll see it abbreviated as an MDR. Really what this is it's the IRS saying, hey, we're going to give the private foundation all these terrific benefits from a tax perspective. We're going to give them the means to incur charitable expenses, and we're going to allow for a wide array of asset classes and philanthropic activities. However, we're going to require private foundations to make sure that they're making distributions on an annual basis. So private foundations are required to make a minimum of 5% distribution every year. Now, this is not 5% grant making every year. This is 5% distributions, meaning that what goes into that 5%, right? It's not just grant making dollars. This is inclusive of charitable expenses, fees for partnerships like Foundation Source or working with an attorney. These all go to that 5% distribution requirement every year. So not just a grant making budget, but again, this is really the idea that private foundations do need to remain active with their distributions. Donor advised funds do not have a 5% minimum distribution requirement, meaning that there's no requirement for donor advised funds at a IRS or a federal level to make a certain level of distributions. Now, again, different donor advised fund sponsors may have their own independent distribution requirement for their particular donor advised fund, but private foundations have that at a kind of overarching national level where donor advised funds do not. Okay. Private foundations also pay what's called an excise tax on income every year. So that for a long time, that was actually a hovering number that ended up either 1 or 2%. But about 2 years ago, the IRS came in and they said, hey, we're going to make excise tax for private foundations a flat rate. It's going to be 1.39% on investment income and realized capital gains. So this is, again, associated with the flexibility and the control that a private foundation is afforded. It comes with a small excise tax. Now, again, still predominantly a terrific means of contribution for our clients because they're not paying income tax. They're not paying a capital gain when they contribute appreciated assets, Chase. So 1.39% is kind of that cost of doing business and working through a private foundation at a tax level. Again, charitable income tax deductions of up to 30% of adjusted gross income for cash, and typically 20% for appreciated securities and other asset classes, right? Real estate, tangible assets, private equity, et cetera. So again, not wanting to go down too far down the rabbit hole of private foundations because we could probably do foundation or private foundations or charitable giving 201 and focus right on private foundations. But in the context of our presentation today, I'll go ahead and pause there for you, Chase.
Yeah, so one question here, and then maybe, I don't know if you had another slide, or I know we're getting to kind of more of a general Q&A, which we got a few questions teed up here that we've been collecting along the way, but for foundations specifically, so you mentioned, okay, you can pay yourself to work for essentially the foundation, correct, right? And that goes to that minimum distribution, but at 5%, but can you explain like what kind of activities? I mean, is it like, hey, I was hanging out and, you know, I looked at some things online. So, you know, that's, you know, what's a reasonable amount? You know, if I have $1 million foundation, am I paying myself $100,000 a year? Is it $10,000 a year? So maybe you kind of talk around some of that stuff.
Yeah, you know, it's a great question, Chase. It's also a really challenging question, right? Because unfortunately, the IRS does not give crystal clear guidelines on any charitable expenses paid out of the foundation, right? So charitable expenses, of which compensation is one of, right? But not limited to. So the same question that you're asking related to compensation would also apply to incurring charitable expenses, right? So for example, if I have a client who's working on a significant clean water project in Africa, and they want to be able to travel there, is it advisable to you know, hire a private jet and rent out the top floor of the nicest hotel in town? Probably not, right? That said, the guidelines that the IRS uses for all charitable expenses out of a private foundation, including compensation, is that those charitable expenses need to be both reasonable and necessary. So when we think about, and you notice I didn't say reasonable or necessary, right? Reasonable and necessary, meaning that the work that's being performed, if we're talking about compensation, is necessary to the foundation's mission. And it also is reasonable in the context of what they're earning. So for example, if we have $1 million foundation and they'd like to pay compensation to a family member or a non-family member who maybe is a disqualified person, terrific that our donors have the flexibility and the ability to do that. it really comes in terrific handy when I have a family who has a foundation and they have, they have a son or a daughter or a niece or nephew or grandchild who maybe has just graduated college, and they're trying to find out what they like to do, and they're going to work on behalf of the foundation as a grant researcher, and they're going to travel around and take meetings with different organizations to learn more about them, because ultimately the family foundation or the corporate foundation is going to support that organization. Can they take a reasonable and necessary salary to do that? Absolutely. That said, can they be paid $300,000 a year if the foundation is $1 million entity? Probably not, right? It's probably not a great idea. So much of what we operate or how we operate is based on optics, right? Does this pass kind of the sniff test, so to speak, right? Is this going to raise some eyebrows if the IRS kind of takes a deeper look at things? So how we advise our clients at Foundation Source, and again, one of the perks that we have at our disposal is working with 2,000 private foundations. It does give us significant amounts of case study to come at these types of questions, right? But some of the things that we'll look at are dig into that reasonable and necessary thing. Are they going to be providing a service that's necessary to the advancement of the charitable mission of the foundation? Should they be compensated to do so? Absolutely. Should they be compensated fairly? Is their compensation going to be in line with a public charity that's paying a similar person to do a similar role? Is that compensation in line with a publicly traded company that would pay a salary to do the same thing? So you really kind of have to take that aspect of kind of fairness into it, right? And make sure that just because it's someone's son, daughter, niece, nephew, grandchild, that they're not being given, undue compensation based on their relation to the family. So it's always a good idea to work through your professional network of your wealth advisor, of your CPA, of your trust and estate attorney, and help define or uncover specialists who can help walk through these types of things for you. They can be very, very powerful activities to be run out of the foundation, but we always want to make sure we're in compliance and doing things the right way. So a very long answer to your fairly pointed question, Chase, but unfortunately that is kind of the world that we're in, right? There's no graph or chart that says if you have a $5 million foundation, then you can pay compensation of up to X. It really tends more to do with an individual case-by-case basis. There are terrific resources out there for donors who wish to explore that a little bit further. And again, there are even independent legal counsel available who will do things like compensation benchmark analysis and really protect our donors to make sure that they're making the right choice for the advancement of their foundation, but also remaining in compliance when it comes to the IRS.
Yeah, well, I think your answer nailed how complicated, of a question this is, right? It's not just a simple, yep, 10 grand or 10% or whatever, right? Really depends. So I got a few questions here, kind of on foundations and some of the other charitable vehicles, but
Sure.
let me save those for the Q&A. I'll let you kind of wrap up this part of your presentation, and then we'll quick jump into a few of those if we have time.
Terrific. Sounds great, Chase. So the reason I like this last slide is because it really talks about the reach of charitable giving organizations in the US, right? A lot of people maybe minimize some of the philanthropic activity because they consider it just a part of their day-to-day. It's a check to my church, or it's supporting a fundraiser at my kid's school. The effect that established charitable vehicles have had on our country are incredibly widespread. Just some of the examples that you're seeing on the screen here are completely funded through private foundations, for example. When we think about the work that significant private foundations, that donor-advised funds, that charitable trusts, and that public charities have had on the world, I mean, we wouldn't be able to do a series of presentations talking about all of that, right? But again, just some examples of how established or formalized charitable vehicles have been able to make a significant impact on the world that we live in today. So won't dig into many of these specifically. I know we have some questions to work through here, but I do like kind of bringing up this idea of how charitable vehicles have been so transformative for society. I think we've touched on the majority of these here, Marsha, through some of the conversation that Chase and I have kind of already employed, but just to circle back, some additional benefits of a private foundation specifically as a structure. It is a formalized structure. It's a terrific means for engaging your family. I have so many families that we work with that love the idea that they can engage their family in their charitable giving mission through a private foundation or a family board. I have so many families who bring on their teenage or their 20-something year kids to help them understand what a board meeting is. And this is how decisions are made. And it's an introduction into business. And it allows them the means to educate their family moving forward on the idea that they've probably got it fairly good. And there's a lot of people in the world that don't at its core level, right? So when we think of private foundations, one of the big benefits of this that we haven't really discussed to this point is the idea that most private foundations are set up with the idea that they're going to run in perpetuity, right? Whoever sets up this private foundation usually has it in mind that maybe their children and their children's children are going to eventually take over this philanthropic mission, extending that means to a much larger audience for a much larger amount of time. The idea that a matriarch or a patriarch can establish something and have that pass through at a very legacy-driven level is very appealing to many donors. So again, won't dive into too many of these directly. You see them on your screen already, and certainly happy to discuss afterward if people have questions. But go ahead, Chase.
I didn't know. Do you have one more slide, or is that we're on to our?
Oh, I'm sorry, I'm off, Marsha. My fault. I thought that was our last slide. So talking specifically about 2020, right? Kind of looking at it as the year that changed everything. 39% of private foundations in the US, again, we're talking about upwards of 80,000 entities, shifted their mission specifically in relation to COVID-19. And what this tells us is that private foundations, while maybe having a stigma of being a little bit more not quite as nimble, are able to really amend their mission and their approach to work toward a very specific cause. 42% increased the amount of grant making related to social justice in 2020. We saw significant events shaping our country, and private foundations were incredibly responsive to those challenges that we were experiencing. A couple of other notes. Grants to individuals was up over 15%. So people who maybe were more focused on giving directly to public charities and organizations decided that they could have more impact in exploring grants directly to individuals and making a contribution to an individual or a family that needed some help. They experienced a medical emergency or a natural disaster affected them. So we saw private foundations be able to be nimble and work within these specific areas as well.
All right. Well, let's see. We got a
picture of me.
Yeah. Any questions there? No. Yeah. Okay. We got a few minutes here, so I want to throw out a few of these questions. One of them, we had some questions around like using multiple strategies, or can you use them all,
yeah.
or are there ones you can't use with other ones? But just in maybe with some of the clients you currently work with, do you see multiple strategies being used? Like, okay, does someone have a I don't know, a CLT or CRT or a DonorAdvise Fund along with the foundation, and how might those work together?
Yeah, it's a great question, and I'm glad you brought it up, because just in the last 2 to 5 years, we've seen such an increase in donors who are working within the construct of multiple charitable vehicles, right? You brought up a couple. Having a CLT or a CRT that ultimately leads to the funding of a private foundation is we've seen an incredible increase in that. Well, what does that do for an average donor? Well, one of the major things that it does is it allows for a much longer time frame to employ your charitable efforts, right? So instead of a donor having a charitable trust established and having specific charitable organizations, specific nonprofit public charities written into that trust that are set up to receive those distributions upon the expiration of that trust, the idea that you can now name your own private foundation and you're not having to distribute all of that money all at once. You can distribute it as little as 5% per year over a much longer period of time. You're keeping more of your asset base invested and hopefully growing through, through a wealth advisor like yourself. At the end of the day, that results in more to give for a longer period of time. Some people see a lot of power in that. Some people look at it the other way. Well, after I'm gone, I'd like to get as much of my money into the hands of my favorite charities as possible. So I don't really care about longevity. I want to make an impact now. So again, very personal decision on how you employ a strategy like that, but nonetheless, a lot of growth in that space. The other area we're seeing is employing both a donor advised fund and a private foundation, right? Some people would maybe use those two vehicles more in a comparative narrative. However, what we're seeing is an incredible increase in the amount of private foundations and donor advised funds used in conjunction. So for example, of our 2,000 private foundations that we partner with, probably at least at minimum half also have a donor advised fund, right? I like to think of it as, in the financial services space, Chase, people like a diversified financial portfolio. A lot of them also want a diversified philanthropic portfolio. They might look to their donor advised fund as a means of making more of their kind of localized or community given gifts, especially if they're working through a donor advised fund at a community foundation. And they look at their private foundation gifts as more family or macro or larger support type gifts. Some look at it that way. Some look at it like, I like the idea that I can leverage having a donor advised fund to maybe act as a recipient vehicle of my giving from my private foundation. As I mentioned before, huge benefit of a private foundation is you can make distributions from your own private foundation to your own donor advised fund. So being able to utilize that strategy is very appealing to people. Some people who have a private foundation collectively as a family might have their own individual donor advised funds, and they like to use this for more of their giving that's done at a personal level and not associated at a family level or at a corporate level, and so on and so forth. So it has become almost to the point where it's kind of commonplace to have multiple charitable giving vehicles.
Yeah, thank you. That's you actually, I think, kind of touched on another question we had just about like flexibility, and if you're unsure at first, but you want to give, what is there flexibility there? So I know we're kind of coming up on time, so this will be our last question here. So when I think of foundation, I think of this traditional, like, okay, you have to have a ton of money and you need to have, all this wealth to be given away. And I think of the Ford family, all these big families, right?
Sure.
But at what point does it make sense to say, okay, yes, like a private family foundation might be a good option for us? Like at what point, rather than just giving to specific charities?
Yeah, great question. And I love your point about flexibility that you brought up before as well, because as we talked about, do we start with a donor advised fund? Do we start with a private foundation? That kind of ties into your second question as well, right? Well, how much is too little? How much is not enough, et cetera. So I like to think of it this way. And when I work with the wealth advisors like yourself that I partner with, I try to arm them with the best means to have the conversation related to charitable giving vehicles with all of their clients, non-dependent on size, right? So for example, Chase, if you have a client who comes to you and wants to talk about establishing a charitable giving vehicle, it's really important to have that conversation all of the time, right? Because you can end up advising them or making suggestions that don't ultimately satisfy maybe their needs today, and then also their needs into the future, right? It's really important. So my rule of thumb, and again, it's going to be different for everyone, but my rule of thumb is that when you're thinking about maybe a charitable trust, a donor advised fund, or a private foundation, you should always have the conversation talking about all of those vehicles at $1 million, or at least a line of sight to $1 million, right? Now, is that saying that for everything $1 million and above, you go to a private foundation, and everything below $1 million, you go to a donor advised fund? No, right? But what we don't want to get into, Chase, is, like I mentioned before, you have a client, the client is going to make an initial contribution of $2 or $3 million. They assume that that's going to be too little for a private foundation. They end up funding a donor advised fund, and then that satisfies their needs for a year or so, right? But then their needs change, or their goals change over time. And where before they were only making distributions or grants to public charities, now they want to explore setting up a scholarship program, or they want to set up gifting directly to international organizations, or they have a son or a daughter, grandchild who wants to come onto the board, and maybe they want to compensate them for some of the work that they're doing. Now you've preloaded a charitable vehicle like a donor advised fund that's not going to allow them that type of flexibility and control down the line. So the reason that it's really important to have that conversation prior to a significant funding amount is because some vehicles allow for portability and some don't, meaning that a private foundation, for example, you go through the process, you set up a private foundation, you get 2 or 3 years down the line, you decide that year 1, 2, $5 million that's in the private foundation, it's just not what you were looking for. You're not maybe getting the buy-in from the family members that you thought you would, who want to participate. You can simply distribute and grant that $2, $3, $5 million over to your donor advised fund at any time. It's no problem. You can start with a private foundation and move it to a donor advised fund anytime you want. Really can't go the other way for the most part, right? You can't front load a $5 million donor advised fund, get 2 or 3 years down the line, decide that, hey, I do want to do these other things that I can only do out of a private foundation. I'm going to move that money from my donor advised fund to a private foundation. All but impossible to really make that type of distribution. You're talking about unwinding taxes. You're talking about different limitations. And again, the real decision ends up lying with the donor advised fund sponsor in that case, because they're now the controlling entity of that donor advised fund. So really important conversation to have. Again, a long answer to your fairly short question, but for any wealth management professionals, I always encourage the conversation. Anytime you're talking about $1 million or more of an initial contribution, always have the conversation. You might find that $250,000 or $500,000, and you're a much better fit for a private foundation. You might find that $5 or $10 million, you're a better fit for a donor advised fund. So there's no firm weighted area one way or the other. The important thing, have the conversation. And then secondly, pick a charitable vehicle that's going to satisfy your needs and goals, not just today, but into the future.
Awesome. Well, thank you, Josh. I think we're out of time here. I really feel like I could sit here and probably talk to you about charitable gifting for another hour, but I'm sure Marche is done with us. So I'll pass it off to her. Thank you so much. I really appreciate your expertise and your partnership and your sharing today.
It's my pleasure.
Well, thank you. Thank you so much. I, again, want to thank the organizations that have made this webinar possible today, and to our attendees. Look for a link soon, an email soon with a link to the replay of this event. And you're welcome to share that replay with your friends and family or colleagues. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming. Thank you again, Josh and Chase, and we will see you at another webinar very soon. Goodbye, everyone.